For most people, something feels deeply wrong long before any chart confirms it. You can sense it while standing in line at a grocery store, watching the total climb faster than your patience. You feel it when rent renewals arrive, when savings don't stretch as far, when every routine expense requires calculation. And yet, when you turn on the television or scroll through headlines, the story seems strangely upbeat. Markets appear resilient. Employment numbers look acceptable. Growth, we're told, continues. The contradiction is unsettling. It feels like living inside two economies at once, one celebrated on screens, and another endured in real life. This disconnect is not accidental, and it is not temporary. It is the consequence of an economic system that has been artificially sustained for years, long past the point where it should have been allowed to reset. What we are experiencing now is not a normal downturn, not a typical recession, and not a short-term disruption caused by a single crisis. It is the unwinding of a long experiment, one built on cheap money, expanding debt, and the belief that consequences could be postponed indefinitely. To understand why the global economy now feels fragile, unstable, and increasingly hostile to ordinary people, we have to focus on one foundational variable that shapes everything else: the cost of money. For most of modern history, borrowing came with a meaningful price. Interest rates acted like gravity. They imposed discipline. They forced businesses, households, and governments to confront reality. If an investment couldn't generate enough value to justify its cost, it failed. That failure wasn't a flaw in the system, it was the system working. Resources were reallocated. Inefficiency was punished. Productivity was rewarded. That mechanism broke after the financial crisis of 2008. Terrified of systemic collapse, central banks around the world pushed interest rates towards zero and, in some cases, below it. What was supposed to be an emergency response became permanent policy. For more than a decade, borrowing was no longer a test of viability. It became an entitlement. Capital stopped flowing to the most productive uses and instead flooded anything that promised even the illusion of return. When money becomes cheap, judgment disappears. Housing prices surged not because homes became more valuable, but because monthly payments became artificially affordable. Stock prices climbed faster than profits. Speculative assets multiplied. Entire industries survived not because they were efficient or innovative, but because refinancing debt was easier than confronting failure. This is how the modern economy, filled with companies that never truly stood on their own. They generated just enough revenue to stay alive, but not enough to escape dependence on borrowing. In a healthy system, these firms would have restructured or disappeared. Instead, they lingered, consuming labor, capital, and attention, without contributing real growth. Over time, they became embedded in everything: employment numbers, stock indices, pension portfolios, and bank balance sheets. The longer this continued, the more fragile the system became. Then inflation arrived. Years of monetary expansion, accelerated by emergency stimulus during the pandemic, finally collided with real-world constraints. Prices rose across essentials: energy, housing, food. Central banks, having denied inflation risks for too long, were forced into the most aggressive tightening cycle in decades. Interest rates didn't just rise. They snapped back to reality. And reality is unforgiving. Debt accumulated during the era of near-zero rates did not disappear when rates increased. It remained fixed in size, but suddenly far more expensive to service. This is where the real crisis begins. Across the global economy, massive amounts of corporate and property debt are approaching maturity. Loans taken out when money was nearly free now have to be refinanced in a world where borrowing costs are multiples higher. For many businesses and property owners, the numbers simply no longer work. Cash flow that once covered interest payments is now insufficient. Assets that appeared valuable under cheap credit look dangerously over-leveraged under normal conditions. This is why failure is spreading quietly, unevenly, and with growing speed. Commercial real estate offers one of the clearest examples. Office buildings that once symbolized prosperity now sit half-empty. The shift toward remote and hybrid work permanently altered demand, but prices never fully adjusted. Instead, losses were hidden behind accounting assumptions and temporary extensions. On paper, everything looked stable. In practice, it was only being delayed. As loans mature, that delay ends. Owners are discovering that refinancing requires injecting new capital into assets worth far less than their outstanding debt. Many choose not to. They walk away. Lenders inherit properties that cannot generate sufficient income to justify their valuation. Losses move from theory to balance sheets. This matters because the institutions most exposed are not the global banking giants often discussed in headlines. They are smaller regional banks, the quiet backbone of local lending, small businesses, and real estate financing. When these banks absorb large losses, they don't fail loudly at first. They tighten lending, credit dries up, growth slows, layoffs follow. We've seen early warnings. The real danger lies ahead, as refinancing pressures intensify. At the same time, a parallel crisis is unfolding on the other side of the world. For decades, global growth leaned heavily on China's expansion. But that expansion was built on an enormous property boom that functioned less like a market and more like a confidence loop. Real estate became the primary store of household wealth. Developers relied on rising prices and continuous pre-sales to fund construction. Debt expanded rapidly. When prices stopped rising, the model collapsed. Unfinished projects, defaulting developers, and evaporating household wealth have left China facing a prolonged slowdown driven by caution rather than consumption. As domestic demand weakens, excess production spills outward. Goods are exported at razor-thin margins, pressuring manufacturers worldwide and exporting deflation into already fragile economies. The global system is now being squeezed from both sides. On one side, asset prices inflated by cheap money are deflating, as borrowing costs normalize. On the other, financial institutions holding those assets are too exposed to absorb the losses cleanly. This creates a feedback loop that policymakers cannot easily escape. In previous crises, central banks had a simple response: cut rates and inject liquidity. That playbook no longer works. Inflation limits how much money can be created without eroding public trust. Government debt limits how much borrowing can be absorbed without destabilizing sovereign finances. Financial fragility limits how much stress the system can tolerate. This is the trap. When economic tools fail, political tools emerge. Control replaces flexibility. Stability is pursued not through growth, but through restriction. This is the context in which new monetary systems are being proposed, not as conveniences, but as solutions to a problem that cannot be solved through traditional means. Digital currencies issued by central banks are framed as modernization, but their true function is structural. They eliminate escape routes. They prevent capital flight. They allow policy to move from suggestion to enforcement. Money stops being neutral. It becomes conditional. This shift does not arrive overnight. It arrives gradually, justified by crises, wrapped in safety, and normalized through necessity. Each step seems reasonable in isolation. Together, they change the nature of ownership itself. Meanwhile, those with the most resources are already adjusting. Large institutions and wealthy investors are quietly reallocating away from abstract financial claims and toward tangible assets, land, energy, infrastructure, commodities, and resources that exist outside purely digital systems. This isn't speculation. It's risk management. The transition underway is not a dramatic collapse. It is slower, quieter, and more destabilizing than panic. Standards of living adjust downward. Expectations recalibrate. Trust erodes. What makes this moment different from past downturns is not severity alone, but finality. An era built on endlessly expanding credit is ending. What replaces it will be more constrained, more controlled, and far less forgiving. The question facing individuals is not whether change is coming, but whether they recognize the shift while there is still time to adapt. This is only the beginning. What makes this phase of the collapse especially dangerous is that it doesn't announce itself with a single dramatic event. There is no obvious moment when everything breaks at once. Instead, pressure builds silently inside institutions that most people never think about until they stop working. Banks reduce lending quietly. Pension funds adjust return assumptions without telling beneficiaries. Governments change accounting rules so losses remain hidden. To the public, nothing appears broken until suddenly, access disappears. Credit is the lifeblood of the modern economy. When it flows easily, growth feels natural. When it tightens, everything slows. Right now, that tightening is happening unevenly and selectively. Large corporations with political influence still access financing. Governments still borrow without restraint. But households and small businesses are finding that loans are harder to get, more expensive, and far less forgiving. This is how collapse begins from the bottom up. Employment is the next domino. When refinancing becomes impossible and margins vanish, companies don't announce ideological shifts, they cut costs. Hiring freezes come first, then layoffs. At first, they're explained as restructuring or efficiency improvements. Eventually, they spread across sectors that once seemed immune. White-collar work, once considered stable, becomes just as vulnerable as manufacturing or retail. Job security erodes quietly, long before unemployment statistics fully reflect reality. At the same time, governments are facing a problem they cannot openly admit. Their own debts were accumulated under the same illusion that cheap money would last forever. As interest costs rise, budgets become dominated not by public services, but by debt maintenance. More revenue goes toward servicing old obligations rather than improving living standards. Taxes rise in subtle ways. Fees increase. Benefits stagnate. Inflation does the rest. This creates a dangerous political environment. Citizens feel poorer, but are told the economy is strong. They work more, save less, and trust institutions less each year. The social contract, the implicit agreement that effort leads to stability, begins to fracture. When enough people stop believing in that contract, compliance becomes fragile. Historically, this is the point where governments stop relying on growth and start relying on control. Financial systems are especially vulnerable during this phase because confidence matters more than capital. Banks don't fail when they run out of money. They fail when people believe they might. To prevent that belief from spreading, authorities focus less on fixing balance sheets and more on managing behavior. Withdrawals are discouraged. Transfers are monitored. Temporary restrictions are introduced in the name of stability. The justification is always the same: protection. Protection of deposits. Protection of markets. Protection of the economy from panic. But protection comes with conditions. Once those conditions exist, they rarely disappear. Each crisis expands the boundary of what is considered acceptable intervention. This is why the shift toward fully digital monetary systems is accelerating now, not later. It is not about convenience or innovation. It is about eliminating uncertainty from the system by eliminating choice. Cash represents autonomy. Physical assets represent exit. In a fragile system, exits are threats. A fully digital financial architecture allows authorities to respond instantly to stress. Capital can be frozen without explanation. Spending can be directed without debate. Saving can be penalized without legislation. None of this requires force. It requires compliance, and compliance is easiest when alternatives are removed gradually. What makes this transition effective is that it does not feel authoritarian at first. It feels administrative, technical, boring. Most people accept it because resistance seems impractical. By the time the implications are obvious, dependency is complete. Meanwhile, inequality accelerates in a way that statistics fail to capture. Those with access to hard assets, global mobility, and sophisticated legal structures insulate themselves from instability. Those without are locked into systems designed to extract value quietly over time. Wealth doesn't disappear, it concentrates. This is the psychological breaking point of an economic collapse. Not panic, but resignation. People adjust expectations downward. Ownership gives way to subscription. Security gives way to access. Risk shifts entirely onto individuals, while control consolidates above them. The system doesn't need everyone to agree. It only needs them to feel powerless to change it. And yet, beneath the surface, behavior is already changing. Trust in institutions declines. Informal economies expand. Barter, side income, off-book labor, and alternative stores of value grow quietly. Parallel systems form not out of ideology, but necessity. When official systems become too rigid, unofficial ones fill the gaps. This fragmentation is dangerous for governments, because it signals loss of legitimacy. Once people believe the system no longer serves them, enforcement becomes harder and more expensive. History shows that this phase rarely resolves cleanly. It either leads to reform or to tighter control. We are approaching the point where that choice can no longer be delayed. The remaining question is how authorities respond when the next shock arrives. Not if it arrives, but when. Because the pressures building now are structural, not cyclical. They will not fade with time. They will intensify. And when they do, the response will not focus on restoring the old system. It will focus on preserving order. That response is the final act of this economic era. Every financial system eventually reaches a moment where it can no longer pretend. Accounting tricks stop working. Extensions expire. Confidence thins. What follows is not an explosion, but a decision. And that decision is almost always made behind closed doors, long before the public realizes it has been made. When the next major shock hits, whether it comes from bank failures, sovereign debt stress, or a sudden freeze in credit markets, authorities will not describe it as a collapse. They will call it a transition, an upgrade, a necessary modernization to protect stability. The language will be calm, technical, reassuring, but the substance will be irreversible. At that point, the system will no longer be about encouraging growth. It will be about managing decline. History offers a clear pattern. When debts become unpayable and trust erodes, governments face only three options: default openly, allow uncontrolled collapse, or quietly change the rules. Open default destroys credibility. Uncontrolled collapse threatens power. So the rules change. Savings are redefined. Ownership becomes conditional. Money becomes less about storing value and more about regulating behavior. Inflation is tolerated, even welcomed, because it erodes obligations without requiring confession. People feel poorer, but nothing is officially taken. This is how wealth is transferred without force. What makes the modern version unique is precision. Policy no longer has to be blunt. It can be targeted, selective, automated. Financial pressure can be applied surgically, justified as risk management rather than coercion. The system does not need to punish everyone equally. It only needs to limit mobility. And mobility, financial, geographic, economic, is what defines freedom in a debt-based world. Once movement is restricted, outcomes are predetermined. People adapt not by resisting, but by narrowing their lives. They delay plans. They abandon ownership. They accept volatility as normal. Over time, expectations reset. A generation grows up knowing nothing else. This is why the end of an economic era rarely feels dramatic in the moment. It feels confusing, gradual, fatiguing. People don't panic, they disengage. Markets will still exist. Businesses will still operate. Money will still circulate. But the underlying promise, that effort reliably leads to stability, no longer holds. Risk shifts downward. Responsibility shifts upward. Accountability disappears into complexity. The collapse, when viewed this way, is not an event. It is a reordering. Those who benefit most from the system understand this well. That is why preparation at the top looks so different from advice given to the public. While ordinary people are encouraged to trust institutions, stay invested, and remain calm, large players quietly prioritize resilience over returns. They seek things that endure, rather than assets that depend on confidence. They plan not for growth, but for survival through transition. None of this requires conspiracy. It requires math. A world carrying more debt than it can ever repay cannot return to normal. It must redefine normal. That redefinition always comes at the expense of those least able to adapt quickly. The most dangerous misconception is believing that this process has a clear end date. It doesn't. It unfolds in stages, punctuated by crises that justify each new layer of control. Each step feels temporary. Each one becomes permanent. By the time the system stabilizes again, it is no longer the same system. What remains is a choice, not between collapse and safety, but between awareness and surprise. Those who understand the direction early have options. Those who are carried along by policies they never voted on and changes they never agreed to. The global economy is not collapsing because of incompetence or bad luck. It is collapsing because it reached the limits of an illusion. The illusion that debt could replace productivity, that liquidity could replace value, and that control could replace trust. When the music stops, nothing disappears instantly. But everything changes. And the question that matters most is not what happens to markets, banks, or governments. It is what happens to you when the system you relied on quietly becomes something else. That moment is no longer theoretical. It's already here. Hey everyone! If you enjoyed this video and want to stay updated with more insights on finance, make sure to subscribe to my channel, Financial Coin. And don't forget to hit that bell icon so you never miss our latest videos.